Hello and good morning all. My name is Eddy Lord and I'm a payment consultant here at Hokodo. I'm really excited to welcome you all to today's discussion, which will cover the 5 key reasons that food and beverage sellers, that's you guys here today, should be hungry for payment terms. Hokodo is Europe's leading provider of digital trade credits, and I'm often asked, what does that mean exactly? That's a fair question. Imagine a business visiting a B2B website. Our solution helps this business access the payment terms they need and expect. Meanwhile, the seller gets paid upfront and in full, which enables them to accelerate their growth. In a few moments' time, I'm going to hand over to our co-host Louis, the president and co-founder of Hokodo. But before I do, I have a few housekeeping points to go over quickly. Firstly, if you have any questions, please type them into the Q&A section. You should be able to see this just below the video panel. Type your question in and then hit the submit button. We've allowed around 10 minutes towards the end of the webinar for these questions to be asked to Louis. Secondly, if you experience any technical issues, the first protocol would be just to refresh your browser. Now, if that doesn't work, please type in your issue to the Q&A section and our tech team are on hand to give you help. Lastly, on your screen, you should be able to see a resource panel. Here you can access useful documents and links relating to today's topic. We've also added in a link to our dedicated food and beverage hub. Do make sure you check those out later when you can. Now that's enough from me. Over to you, Lou, for an introduction.
Thanks a lot, Eddy, and good morning, everyone. Very excited to co-host this webinar. So my name is Louis Carbonnier. I'm the co-founder and president at Hokodo. Hokodo is a pan-European scale-up dedicated to building the best payment solutions for B2B. We offer a range of solutions for pay now and pay later, and we'll be discussing pay later quite a lot today. We're headquartered in London, where we have the majority of our staff, but also have offices in Paris and Vilnius. We're backed by Lloyds of London, Citi, and BNP Paribas, and more than 100,000 businesses have used Hokodo to access better payment terms, have used Hokodo to pay in a different way. And we're very excited to share some of the lessons that we learned along the way with all of you today.
Great stuff. Thanks a lot, Louis. Okay, I think everyone should be hungry for some payment terms now. Let's see what's on the menu today and jump into our first slide, which is simply titled Increased Liquidity in a Cash-Strapped Sector. Over to you, Louis.
Well, as we all know, the food and beverage sector is one that's naturally very competitive, and it's a feature that participants often have to wait for a long time for invoices to get paid. And recently we've had some additional sources of strain with COVID, staff shortages, lately the rising energy costs, commodity costs, and all this has led to margin compression. And as a result, we've seen an increase in invoice being paid late or never. So the latest statistic for our sector in 2022 was that there was an increase of 79% in those late invoices. And that has a dramatic impact on the whole supply chain of food and beverage. And concretely, this creates a risk of a domino effect where one business paying late has a knock-on impact on their suppliers and so on and so forth. And in the UK, for instance, one business failure out of 3 is caused by the non-payment or the late payment of an invoice. So cash is king, cash is of the essence. And when we're entering that environment of constrained liquidity, it's very important to find the solutions that can unlock that liquidity, that working capital, and payment terms, and in particular a digital payment term solution like Hokodo's is a very, very relevant way to unlock liquidity and growth across the whole value chain.
Okay, so the sector is pretty strained and needs some liquidity relief. Louis, can you talk me through how payment terms work in practice and how they can help us navigate through this tough environment?
Yeah, well, the thing about the payment terms is that you want to bring a solution that satisfies both the sellers, that we also call the merchants in our jargon, and their customers, the buyers. And really, the objective is for the buyers to get access to the payment terms they deserve and that they don't necessarily get today from their suppliers. And on the other hand, for sellers to get paid when they want to get paid, when they need to get paid. So if you take the example of a restaurant owner, for instance, as the client, if you allow them to pay you as their supplier on 30 days, for instance, that's going to have a very positive effect on their whole cash cycle. Essentially, they'll be able, for instance, to order the meat or the vegetables that they need, pay them in 30 days, and in the meantime, they will be able to sell the meals to their clients. And that essentially allows them to pay their wages, pay their energy bills, and totally alleviates the burden of cash flow. And then if you as the supplier get paid as soon as you ship the goods and don't have to wait for 30 days, well, it's the same thing. Your working capital need just decreases and you have a win-win situation both for the seller and the buyer. So how does this work with a digital payment term solution? Well, typically, there are lots of different customer journeys, but let me take the standard case of a buyer coming to a website or an app to make their purchases. Well, the buyer will start by filling their cart as they would on Amazon. And then in the background, Hokodo will be assessing their credit worthiness so that when they reach the payments page, the buyer only sees the payment plans for which they've been approved. So it could be that buyer one gets offered 30 days and buyer two gets offered even 60 days because they're loyal and they've got a good payment history. And that's all completely instant. Then the next step is for the buyer to choose their settlement method. That's also very important online. Will they want to pay with a bank transfer, by credit card, with a direct debit, which can be very handy if it's a buyer who comes back very frequently and wants to do many purchases every month. And then they just check out. And 30 days later, if that's the payment plan that they've selected, Hokodo will take the money corresponding to the transaction from the buyer. So that's the journey from the buyer side, and you can see that it's very slick, consumer grade purchasing experience. And on the other hand, from the seller's perspective, if you've granted those payment terms, those 30 days to the buyer, you have the option to then choose when you want to get paid. Are you happy to wait until the due date? Or would you like to be paid as soon as the goods have been delivered, for instance, and get the maximum liquidity relief? And in parallel, Hokodo will take care of all the credit checks, all the limit management, all the collections done in the background. And in case the buyer doesn't pay or pays late, that has no impact on the seller. They get paid no matter what at the dates that they chose.
Amazing. Thanks, Louis. Super clear breakdown on how Hokodo works. Now, as we move on to our next slide, it's a lesser known benefit of payment terms, but it's a really important one. Louis, can you talk us about how access to credit can improve quality control?
Yeah. Well, the specificity of the food sector is that we work with fragile goods and supplies that are often perishable in nature. So that puts a lot of burden on the whole operations and logistics chain, where we need specific storage conditions, refrigeration, transportation, which are very very crucial to make sure that the quality is at the level that we want. And in fact, this also has a big impact, not always, not always well assessed on the whole finance and operations chain. And this is a bit like, below the tip of the iceberg, something that's going to be generated by the fragile goods that we transport is a lot of partial cancellations, refunds, changes in the orders, and that typically, when you're in the payments industry or in the finance department, that's very tough to handle, because then that causes a lot of credit notes. And if you're a traditional payments provider, one KPI that you monitor is the percentage of refunds that your merchants generate. Well, if a merchant is selling, say laptops, usually you send 10 laptops arrive, and it's the rate of refunds is very, very minimal. Now, in the food sector, it very often happens that someone orders 10 kilograms of beef, and then when it's delivered, and it turns out that it's only 9.5, or that 1 kilogram was not wrapped properly, sent back, and then at the last minute, one needs to adjust the invoice to what is the new weight and therefore the new order amount, and that creates a mechanic that's very painful to handle when you're a non-specialist payments provider. So, payment terms, they're useful to address this specific use case on two levels. Well, number one, it creates a lot of trust from the buyers, because you don't have to pay upfront before receiving the goods. So, if you're like Saint Thomas and you only believe what you see, then that's a positive sign. And from the merchant, it's also a sign that you trust the quality of your food if you give of your products, if you give that delay to the customers. And then it's also useful in terms of convenience, because thanks to the payment terms, there will be fewer adjustments, fewer credit notes along the finance chain.
Amazing. Thanks again, Louis. I mean, that sounds like a pretty significant advantage that's tailored for food and beverage sales. Now, in practice, Louis, how would that work for merchants?
Well, the way we see it work is through what is often called a trade account. So imagine, as a merchant, you tell your customers, look, everything that you purchase in November, you will have to settle at the end of the following month. So let's say at the end of December, in this case. This means that as the merchant, the seller of the goods, you just keep a tally throughout the month of what shipments are made, what goods are being delivered. And another feature of the food and bev sector, I didn't mention it, is that you often have lots of orders throughout the month. It's very common to have dozens of orders every month. So you just let this happen throughout November, and you send a big consolidated statement of account to your buyer at the end of the following month. And this way, this is much easier for your accounting department, because they only have to track one payment and reconcile one payment. And if we look at the mirror effect, what happens for the buyer? Well, instead of having to pay, imagine they make 20 orders in 1 month. Instead of having to make 20 bank transfers and tracking all of these outflows from the bank accounts, reconciling them to lots of individual invoices, they get one big invoice at the end of the following month, and they only have to make one payment. Saves them a lot of time in terms of accounting. The finance department of your client will love it, and of course it also creates some efficiencies, saves some payment processing fees, and you can see how less handling there is in terms of credit notes, clawing back, netting from the previous payments. It's all much cleaner and easier to manage.
Amazing. I mean, it's super reassuring for sellers to know that their money is set aside and will be unlocked at their time of choosing, whilst at the same time building trust and reputation with buyers. Now, as we move on to our next slide, probably no surprise, sorry, to anyone here in the food and beverage industry, but it's hugely competitive. Louis, I was hoping you could talk to us about how payment terms provide a unique competitive advantage to suppliers.
Yeah, of course. Well, as you mentioned, it's extremely competitive out there. It's hard to build differentiation. And payment terms are a way to build that differentiation on the market, especially in the current environment. What we've seen over the last few months is that a lot of sellers were actually constraining the trade credit that they give to their buyers. And especially the long tail of buyers are getting some very short credit terms now, or even no credit terms. But one feature also of this fast-growing market is that it's also a very innovative one, and it's currently migrating online at a very fast pace. And if we look at what is the fastest distribution channel, the e-commerce channel is growing at a fast speed and presenting us with a big opportunity. So it's currently growing double digits, about 17% per annum. And that's really, when you compare all the different channels, that's where the big opportunity lies right now. And that's where we can capture market share. It's estimated that the food industry will account for $800 billion of sales by 2030. So that tells us, what the value pool is out there to be captured. So as the market transitions towards online, it's still going to remain competitive. And what's interesting is that, there's this general wave of digitization, which is being driven by some interesting outfits and marketplaces in particular. Think of the companies like Choco, Reki, Foodo Market, Collective Food, Cheetah, and some of them are clients of ours. They're basically setting a new standard for what the online channel should look like and bringing the kind of Amazon grade or consumer grade experience to procurement in the food and bev sector. So that presents us with a number of challenges, because in digital, the differentiation comes, of course, the core product is still key, it's the foundation, but the rest of the differentiation will come from the user experience, and in particular, the trust and the convenience that we can inject into the purchasing journey. So to give you an example, one key stat that we need to monitor at all times is the cart abandonment rate, and it stands at 70%. And if we can optimize that variable through better user experience, more trust and more convenience, then the economics of our e-commerce business are going to be radically transformed. And that's where payment terms kick in. That's where essentially they help us improve the conversion rates, the average basket size that we see at the checkout.
Amazing. Thanks again, Louis. But let me just get this part straight. Payment terms won't just increase conversion and customer loyalty for food and beverage sellers, but they are a clear USP setting you apart from their competition. Is that right?
Yeah, that's right. Because right now, those payment terms, they're relatively common when selling online. In fact, in the UK today, more than 50% of B2B transactions are done on payment terms. So that means, company A sells to company B, sends them an invoice and tells them, please settle this invoice within 30 days, 60 days, whatever. So this is how B2B trade is happening at the moment. However, there is no good way of handling those payment terms when selling online. So a lot of businesses currently have a suboptimal online journey whereby they ask their customers to pay upfront when they order from their website. And that's very clunky. And being able to offer those payment terms in an omni-channel experience, being able to give buyers the credit they deserve, this is truly a differentiator. And this is something that sets you apart from the competition, because let's face it, all else being equal, let's imagine you sell the same product as your competitor roughly, and at a similar price point. If you're able to give 30-day payment terms when your competitor isn't, then you'll win the deal. And that's where you can even price at a higher price point if your user experience, the trust and the convenience that you have in your journey compensate for the price difference. So, at the end of the day, I think payment terms are about to become a must-have in the online journey. And it's only when this is fixed, when the payment experience online is fixed for B2B, that we will be really able to migrate our customers from a physical or offline experience to a truly omni-channel purchasing experience.
That's super insightful. Thank you so much, Louis. As we move on to our next slide here today, it's from my understanding that payment terms can do wonders for customer loyalty and retention. Louis, can we discuss that one next, please?
Yeah, so it's, we've just discussed how the payment terms optimize the journey and they have a positive impact on conversion rates, on the average basket size. And that's true. Like, on average, we see a bump in conversions of 20-25%, an increase in the average basket size of 15-20%. And that's good. But actually, the biggest benefit is on loyalty retention, and that translates into purchasing frequency from buyers. So once the buyers have their trade account open with a given merchant and they're able to go back to the website, fill their cart, purchase in one click, then we see that this has a massive impact on behavior change. And sometimes, a supplier who was only the third or fourth supplier for a certain client, and they would only use them to top up when they were missing some items, suddenly that merchant becomes the first supplier. And because the buyer knows that they have that trade account, and it's a bit like in the old offline world, knowing that I have my trade account with my trusted supplier puts me in a behavior where I'm just on autopilot making my purchases, and I'll settle them at the end of the following month. And concretely, in terms of impact, entering that dynamic of a very fluid purchasing journey and a trusted relationship with my supplier who gives me credit because they trust me, generates on average a 45% increase in recurrence. So that's 45% more business on a recurring basis. So that change in loyalty, I think, in the long run, is even more powerful than the conversion and the increase in basket size.
Amazing. I'm going to ask you to break it down again, Louis, for our audience today. What does that mean in practice for sellers and buyers?
Well, if you're a seller and you've managed to build that long-lasting relationship with a customer and they've got that trade account with you, then essentially you'll be capturing much more share of wallet from your clients. And it's what we see is merchants becoming very sophisticated about it. So sometimes when they have a segmentation where they look at the potential of their clients, and when they see a client who's high potential and they think that they're not winning their fair share of wallet from that client, you can then run some marketing actions to activate the buyers and tell them, look, you have a 10,000 credit line, you've only used 1,000. Or, did you know that you could benefit from 60-day payment terms if you make these purchases? So this is really a great way to activate buyers And at the end of the day, that's something that's going to drive the cost of acquisition down from the merchant's point of view, because your value proposition becomes so much stronger. You're selling plus providing a cash flow relief to your buyer, and in a way that's almost as if you'd been empowered to have a kind of embedded finance offering on top of your core product. And then if we put ourselves in the shoes of the customer, or the buyer then has found a merchant who truly trusts them, who's put them on a trade account, and they benefit from that kind of one-click checkout experience that they have as an individual when they're shopping online on Amazon, and which is so rare still up to today in the B2B world, where supplying still entails a lot of back and forth phone call, emails, and all this can now be digitized.
Amazing. That's super useful, that breakdown, Louis. Now, as we move on to our fifth and final point that we're going to discuss today, it's actually one of my favorites. It's about how payment terms can actually facilitate geographic expansion. Louis, could you talk us through that point, please?
Yeah, well, it's true that in the food sector in general, the local sourcing of produce is very important, and we all tend to start with a local community, and that makes sense. That's also how Hokodo started initially in the London region. But one of the beauties of a digital business model is that it scales. And very often we see that our clients have that kind of tipping points at around 25, 30 million turnover, where suddenly they start to get demand even from abroad. And you've got then the scalable processes to get there if you have a payment solution that scales with you. Because going abroad comes with challenges for the finance team, for the payments workflows. How do we do invoicing in Benelux? How do I credit score a buyer in Germany? How do I detect fraud in Italy? What are the expected payment methods in the Netherlands? And in the UK, we tend to pay by bank transfer, direct debits, credit cards if it's a small basket. But in the Netherlands, they have this payment method called IDL, which is a kind of account-to-account direct transfer, which makes up more than half of the business transactions, and buyers just expect it there. In Germany, they have Sofort. In Belgium, they have Bank Contact. And bringing that optimal purchasing experience actually means bringing to the end customer the expected combination of payment plans and settlement methods. And having a partner that allows you to expand with confidence, protects you abroad against the risk of non-payment, supports your working capital, allows you to then reinvest some of that working capital into marketing to deploy abroad. And then having the payment terms bolstering the proposition also allows you to make a bigger splash when you open in a new market and boast those 30 or 60-day payment terms that buyers love, especially in the current environment.
I mean, yeah, that sounds like a serious game changer for sellers that want to cross borders. Now, the ultimate question for you, Louis, is what specifically makes Hokodo a good partner for these sellers?
Well, we're a specialist B2B payments provider, and we're an electronic money institution passported across all the European Union. So for English companies that want to go abroad, we can support them there. We've got local teams of credit analysts, collections officers, customer support that will take care of their foreign customers. And of course, will protect your sales into foreign countries. So against all risks of fraud, non-payment, we're backed by Lloyd's of London. So we reinsure that risk so that you can grow, focus on the growth. Your job is to focus on the expansion, growing the business, and we take care of the payments and the accounts receivables management. And one last point that I'd like to mention is a challenge that our merchants often face when expanding abroad is that they've built a good stack that works in the UK perfectly, but then they soon realize that maybe in the UK the best scoring solution might be Credit Safe or Experian, but then for credit checks in Germany, well, it's going to be a Credit Reform. If you go to France, it's going to be Altares or Elisphere, and then they need to do lots of additional integrations, and then you have this new payment method in Germany, and then suddenly you started to extend payment terms to your Dutch customer, and you have some overdues. And how do you collect in the Netherlands? Then you need to have some collections officers or collection solutions, and that's where you start gradually bolting on lots of solutions, and you end up with 12 integrations where you could have just one to rule them all. And Hokodo allows you to do just that, essentially scale abroad without facing the risk of non-payment, offering the best UX to your customers, but without the need to add on new integrations. So that gives you really one provider that simplifies and streamlines your finance operations.
Amazing. Thank you so much, Louis. That's a really insightful discussion. Everything we've spoken about today can be found in the resource panel, so please do click into those links and explore some more. We've come to the Q&A section of our presentation today, and I've had a couple of questions come in already. I'm going to put these to you now, Louis. So the first one is, I already offer payment terms to buyers off my own balance sheet. Is what you offer majorly different from this?
Well, it's amazing if you already offer payment terms. It's really a good start. And the next question would be, are you able to offer payment terms online as well to your customers? Is it an instant process, or do customers have to apply for it, wait 24, 48 hours? Because that's going to hurt your conversion rates. And that's, people expect an instant purchasing process when they come online. The other question would be, what percentage of your customers have access to payment terms? Is it 50%, 60%? Sometimes we even see as low as 20%. If that's the case, then you're leaving a lot of money on the table, because when you think of it, what's the percentage of businesses that go bankrupt every year in the UK? Well, depending on the year, it's 1 to 2%. So the actual, if you're only extending credits to 50% of your customers, this means that there are lots of good people that are not getting the credit they deserve. And with a solution like Hokodo, you could actually push that acceptance rate to 80, 85%. And that allows you to basically unlock growth for your business. So that's really what's at stake here.
Amazing. I've got another question for you. How is this different from invoice factoring?
So that's a very good question. So invoice factoring is a great solution if you're looking for working capital relief, because essentially you have an invoice that's due in 60 days. You go to your bank and the bank pays you for that invoice in the same way as Hokodo would. But a digital payment terms solution like Hokodo's does that, plus also much more, because factoring doesn't do anything for your user experience. It's something purely financial that happens in the background. Factoring doesn't help you with conversion rates, doesn't help you with providing a better payment journey to your customers, a choice of settlement methods, a choice of payment plans. So, I'd like to view Hokodo as a kind of e-commerce checkout solution that provides you, yes, with financing, that's right, and liquidity relief, just like factoring would, but also with payment rails, with a choice of pay now and pay later, depending on what's most adapted to this particular customer and situation. Also with support with dunning, collections, credit insurance, and a layer of fraud protection, which is extremely important with in the case of online sales. ID theft, impersonation, chargebacks, those are day-to-day concerns in the digital world that can totally kill the profitability of your website. And you'll see it, especially as you grow. Usually when you're doing small volumes online, if you're trading 1 to 5 million, then that's not going to be a big concern. But once your website becomes more exposed, you have all sorts of people who try and get a free ride, and making sure that you have a provider that that protects you against all those chargebacks, those ID thefts, account takeovers, and so on, becomes crucial to have safe growth.
Nice. I mean, I'm often asked that same question on calls. I think I need to get you onto the call as well, Louis. Some great points there. I've got another one here for you as well. So what happens if the buyer ends up refusing to pay for their order?
Yeah, well, that will happen every now and then, especially in the current environment where many buyers are strapped for cash. So what happens is nothing changes for the merchant. So remember, if the sale happened, it can be. We talked a lot about online and websites, by the way, but that also works for telesales or any other channel. So as the merchant, you've made the sale, you've shipped the goods. Hokodo has paid you for the invoice, and from that point onwards, it's no longer at risk for you. Then it becomes Hokodo's responsibility to chase and collect, which we do in a very tactful way because it's B2B, and these are commercial relationships that you have. And what we want collectively is to foster that loyalty and repeat business. So our interests are aligned there. So we will collect, and eventually, if the buyer went insolvent, which can happen, then nothing changes for you as the merchant, and for us, we're eventually reinsured by Lloyd's of London.
Great, good stuff. Thanks, Louis. And this looks to be the final question that I've got through. What if I wanted to keep my collections in-house?
Yeah. So we often work hand in hand with merchants on the collections piece. So merchants come into two types. You have type 1, who wants to outsource collections. Takes an awful lot of time, and they tell us, well, Hokodo, as part of your service, please run collections for us, and that's fine. Our solution does just that, and we're able to do it in a much more scalable way than most of our merchants. We collect in England, in France, in Belgium, Netherlands, Germany, Italy, Spain, Denmark. So that's something that it's no longer a cottage industry. But then you also have type 2 merchants for whom collections are often the angle they come from is collections for us are an interesting commercial touch point with our clients in order to cross-sell or upsell or close our next sale. So they usually want to retain, it depends, 20 to 30 days of chasing after an invoice is due, so that they can actually have that commercial dialogue with their clients and use it as an opportunity to cross-sell. And in that case, yeah, of course, the way we divide responsibilities is that the first 20, 30 days of dunning remain with the merchant, and we only take over when there's a clear case of, it's overdue risks there's a risk of turning into bad debt, and that's when we help the merchants.
Amazing. That's all our questions we've got today. Any final points before we call it time, Louis?
No, well, thank you very much to everyone for your participation, for the great questions. I think in the food and bev sector, there's a big wave of digitization, and now's the time to put our ducks in a row and give our clients the experience they deserve, and really fix the payments part, which is pivotal in the checkout experience. So very, very happy to contribute to this wave of innovation in the industry.
Amazing. Thank you so much, Louis, for all your insights today, and to the audience for joining us today. Before you all leave, there's an exit survey. We would greatly appreciate if you could fill that out. Any feedback is good feedback. I've learned a lot today, and I hope you have too. That's all from us. So enjoy the rest of your day. Thank you so much. Bye-bye.
Thanks, everyone. Goodbye.
Goodbye.